Hi, this is Kim Butler. Today, Todd and I are going to talk about the loan analysis calculator, and this will be a two-part demo. There's a lot that you can do with this calculator. In our 3-day truth trainings, we tend to spend 3 or 4 hours on it. So this is the super short version. Go ahead, Todd.
All right, so we're going to go over it, like Kim said, quickly, and ultimately we're just going to compare, just to make it easy, two different interest rates. But I want to start with one piece of it, and we're just going to focus on the left-hand side on the loan one, and we have the ability to change the name of each individual loan as well as the overall calculator. So if we can change the title on the calculator by pushing on the title button, but if she clicks up there where the loan is, right clicks on it, then we can actually change the name of each loan, which will help you keep them clear as well. So we'll put 5% loan on this one as an example. And when we get to it, we'll put 6% on the loan too. We can do it now just to see what the difference looks like between the two. Okay. All right, so on our loan balance on the left, let's put in a $50,000 loan. We'll put a loan rate of 5% on this. And this is the time frame that we're going to pay the loan back. So let's say we're going to pay this back over 60 months. So we'll put 60 months in here. The calculator is defaulted to monthly. We can change it to annually. Down where Kim's cursor is, you can see we have an annual, monthly, quarterly, or semi-annual option on when that compounding period is. Now, we only see 1 month showing up here, even though we put 60 months over there on the left. So there's a difference when we pay a loan between the time frame on the loan and the time frame that we want to illustrate. So what I want to do here on my illustration period, if I want to keep this loan all the way out the whole time frame, then I'm going to make my illustration period match that at 60 months. And now we're going to see every single year, we're going to see the beginning of month loan balance decreasing over this time frame, the interest charged also decreasing as we pay principal down. The interest is going to be less since it's always based on whatever principal is left over. And we're going to see our principal payment, which is actually increasing over time. And we see the end of period loan payment total and the end of month balance as it decreases over time. All right, so here we have an option that I think is really helpful too when a client does take out a loan, whether it's a life insurance loan or they're asking for some help on an existing loan. One of the things that we can do where it's right now the months are just listed as each month all the way down, we can change that up in the upper middle section where it says period number. We can change that. If she clicks on that, it'll actually put a date on there. We can put a start date on it. So it would help somebody take this and be able to check it off. Oh, okay, I've got to make this payment here, 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 all the way down the line. So actually, it could definitely help somebody paying back a life insurance loan to make those payments if they have some kind of schedule. All right, so let's go ahead and switch that back. I think it'll be easier for our example here. So what it said was we were going to look at a comparison. So on the right-hand side, and you can click that loan view to loan 2 if you want to, Kim. We're going to put in the same $50,000, but we're going to do this at 6% over 60 months. And we see that this payment is going to be $966 instead of only $943. If we do a comparison there in the middle, then now we can see the difference kind of side by side. It eliminates some of the columns that we have and gives us the difference in the way this account would act. But if we wanted to spend the same amount of money on each item, we have the ability to change the total amount of the payment. And there's a couple different ways we can do it. So over on the left, you'll see the alternate payback option. So I can change one of those 3 items. I can change either the loan rate, the months, or the monthly payment. And then it'll automatically calculate the other options. So the easiest way for me to do this on this example would be to click there beside months so that I can change the months, or sorry, the rate. You had it right the first time, Kim, sorry about that. If we change the rate and we put in 6% there, then it would calculate the same $966 payment. And what it would show me is if we paid the same $966 that our option was on the 6% loan, but we only had a 5% loan cost, then we could accumulate that difference. So it shows us there on the cumulative savings. And then if we went over to the net savings rate and we put in a net earnings rate that money could be applied to, say of 4%, then the difference would be over the 60 months, we'd actually accumulate an extra $1,500. So the impact of being able to shave a percentage off of our loan rate, going from 6 down to 5, could make the difference of having an extra $1,500 for the same payment that we would be paying on the 6% loan.
Fabulous. So if you want to hear more about how to use this calculator, it covers the idea of the 15-year versus 30-year mortgage discussion. It covers equipment leases and a variety of other things. Join us at one of our 3-day truth trainings. We'll look forward to meeting you there.